Hello and welcome to another segment. This one is on trade restrictions. So you'll see elsewhere in the reading where we focus on the benefits of international trade, why it's a good thing, arguments for and a couple against. But this one is really on restrictions. How can people try and reduce the amount of international trade? Really, it's just a list of different restrictions and then we need to look at their impacts. After that, we'll talk about unions, different types of agreements, which is very factual, kind of dry material. But it's the early part of this segment, which is absolute dynamite. So here are the restrictions. Tariffs. Pretty straightforward. It's a tax imposed on imported goods, a tax at the border, if you like. And quotas, a limitation on quantity. So tariff, you just add to the price. Quota, you limit the amount coming in. Thirdly, export subsidies, so they're payments by the government to domestic exporters to try and boost exports. And minimum domestic content, a required proportion to be sourced domestically. Those middle two are not really as exciting for us in the exam, at least, as tariffs and quotas. Finally, VERs, voluntary export restraints. That's an agreement by a country to limit the quantity of goods it will export. So pretty rare these days, barely legal, but what we're talking about is an exporter voluntarily saying this is the maximum amount I am going to export to your country. A good way to look at VERs is to compare and contrast to quotas. So a quota says only 3 million units are coming into my country. That's all I'll let in. Whereas on the other side, the exporter is saying in a VER, I'm only going to send 3 million units to your country. So it's the two different ends. The point of a VER, well, we'll see from the diagram, it's the exporter trying to capture the gain. So they're the restrictions we need. It's been way too long without a diagram in the world of economics, so here it is. It's really up to you how much you put into this diagram, how much effort you kind of put into trying to learn it. Obviously, objective test question, you're not going to be asked to draw this out, but I personally think it is helpful to see the effects and how they work. If you really hate it, there is a table coming up soon which will summarize the effects for you. And if you just want to learn that table, you're in good shape. But I think this diagram helps explain what that table tells you. So here we have a nice straightforward supply and demand diagram, but it's domestic supply and domestic demand. Obviously, without world trade, if we only had domestic supply, domestic demand, there's your beautiful equilibrium and there's your price. Here is your quantity. But we are allowing trade. So if we allow trade, we look at the world price. World price is here. That means our domestic consumers will benefit because they can pay just that world price. Here's our domestic supply at that price, so way down here. That's all you're getting domestically. But at that super low price, massive domestic demand. So we have excess demand. How are we going to fill that? Imports. So we allow free trade, and that is your level of imports. And everybody is happy. But what if we put in place restrictions? The easiest one, I think, to picture is a tariff. So let's say we put a tariff in place. What's that going to do to the world price? Obviously, we assume it's going to increase. We just take the world price and we add the tariff. So you can see the price with protection is now higher. So who wins, who loses? Well, let's have a look. With that higher price, you can see we now have domestic supply here, that's increased, and domestic demand here, that's decreased. That will decrease the amount of imports. So again, we can use the diagram to illustrate it. With that higher price, we now have a lower level of imports. Now that's imagining a tariff, add the price, reduce the imports. You can also think of this from a quota point of view. If we'd said this was our quota, then we could read up from that import and derive the price. So this works both for a quota and for a tariff. Now, what's happened? we need to go back to the idea of producer and consumer surplus from that basic econ material, that primer material, if you like. So we're going to lose out here if we're consumers. If you think of your consumer surplus, originally this was the world price. So this was the demand that was getting filled in total. So this huge triangle here, all of that was consumer surplus. Down here, domestically, if you look at your suppliers, when we had free trade, our domestic supply added into the imports would give us our producer surplus, which is going to be down here. Now, what happens when we increase the price? Diagram will show us we start to lose out. And we lose all of that consumer surplus. That whole area, two-toned as it is, all disappears from consumer surplus. So, fact, domestic consumers lose out. That whole shape is every bit of consumer surplus that's gone. But it's not all lost forever. Where has it gone? Well, you can see that rectangle in the middle, labeled tariff revenue quota rents. If you look at that rectangle, it's our new smaller amount of imports multiplied by the new price minus the old. That's the tariff. So that's the units imported times the tariff. And if it is just a straightforward tariff, that is tariff revenue. Who gets the tariff revenue? The government. So some consumer surplus has disappeared and gone straight to the government. If it were a quota, well, this is still the increase in price times the amount of imports. That's known as a quota rent. If the government does nothing about this, that quota rent goes back to the exporter. Whoever exported the goods to your country picks up that quota rent. However, if the government is smart about it, what they can do is actually charge for that quota. If you want part of this quota, you have to pay this much. And in that way, charging a quota rent, the government picks up that rectangle. Now, it's worth at that point just stepping aside and talking about VERs. If the government imposes a quota, it is ambiguous who picks up this quota rent. So, if it's a VER, the point of the VER might be by the exporting country to pick up that rectangle. So some of the consumer surplus goes to the government, or if it's a quota, VER potentially to the exporting country. What else? Well, again, the diagram will show us. This big chunk here has turned into producer surplus because our domestic suppliers now have extended our producer surplus, so it's now all of this. So they can charge a higher price, they gain. So some of the consumer surplus gone to government, potentially exporter. Some of it has gone to the producer. But we still have two triangles of death, the lighter colored triangles. They don't go anywhere. They are dead weight losses. So dead weight losses go to nobody. It is a less efficient solution. So reasons for trade restrictions then. Given we have dead weight losses and it's less efficient, it doesn't seem a sensible thing to do. Why are we doing it? Well, two primary goals. One, protect domestic jobs. Two, protect domestic producers. Yep, they are two goals, but they're obviously kind of politically the same thing. But they are the arguments. Other reasons, countering foreign trade restrictions and export subsidies. That's always a sensible adult approach. You've done it, so we're going to do it in response. Anti-dumping. Dumping is where an overseas country has excess supply, cannot sell these goods at any price domestically, so this dumps them on you. Or just revenue from the tariffs. We want to put a tariff in place to get revenue. Finally, interesting point, large country. If you're big enough, you could actually decrease the world price by imposing a sufficiently low quota or high tariff. Why? Well, if you do that, you might actually incentivize producers who still want a part of this market to try and get their prices down to counteract that tariff. So that could be an argument in favor. All right. Here's the table I mentioned earlier. I think that diagram helps explain, just kind of puts it in your head. But every single candidate in the world who's done any work on this Forex, this international economics reading, will have this table in their head. We have the tariff quota, VER, and export subsidy, what it does to your domestic consumers and producers, the government, and the foreign exporter. So let's make sure we're happy. Easiest thing to do is to knock out those first two columns. So it doesn't matter what we're talking, tariff quota, VER, export subsidy, they are trade restrictions. And across the board, a trade restriction will hurt your domestic consumers and benefit your domestic producers. So consumers get hurt, suppliers domestically gain. So there's really nothing else to learn there. The government, I think this is easy as well. The government gains from a tariff because they're getting tariff revenue. The government gains from a quota if, and this is the kind of little asterisk, if you will, if they manage to collect a quota rent. So if they force you to pay to be part of the quota, then the government can collect it. If they don't, then it goes to the foreign exporter. So it depends on how they set it up. Now, let's compare and contrast that quota to the VER. If it's a VER, it was the exporting country who set this up. So certainly the government isn't getting it. So the gain goes to the foreign exporter, the main reason for the VER. As I say, I don't see them anymore. Cars in the 1980s from Japan to the US is the all-time classic example. Finally, a subsidy, again, I think is pretty straightforward. If the domestic government is subsidizing exports, it's paying money it's losing. Nothing to do with the foreign exporter because there isn't one, it's just a subsidy. So a huge amount of information on that table. If you understand what's going on, it doesn't take much time at all to try and learn it. It's pretty straightforward. That's the dynamite material in this segment. What follows is a little bit dry, lots and lots of definitions, but they are going to come up in the exam. My advice, just keep throwing it in these segments here and there. When you get to your last 6-7 weeks of study, you're doing practice exams and debriefs. That's where I would start to learn a lot more of this dry material. And I'll try and point it out as we go along. This is dry. Reasons for capital restrictions. So why do we bother doing this? Why do we either just stop financial capital coming into our country, make it ridiculously not worth your while with huge taxation at the border, or stop you taking it out again? Well, reasons why we're doing it, to try usually to reduce short-term volatility. Now, if you're just putting way too much in here and things are going crazy, let's just calm it down. That's the short-term benefit. But long-term, you'll be isolated from global markets, and just like all of our discussion of comparative and absolute advantage in goods and services, it will decrease economic welfare. We don't like trade restrictions. We don't like capital restrictions. Now, to finish off, a whole list of definitions on trading blocks, common markets, economic unions, and then a little bit on balance of payments. So, economic welfare is improved by reducing trade restrictions. So let's try and do that. We can try and reduce them by setting up trading blocks, common markets, and economic unions. So here we go. First of all, a free trade area. Removes all barriers to trade between member countries. NAFTA is a classic example. And I presume, as I'm speaking to you now, that still exists. Customs union. So you take your free trade area and you add in restrictions with non-members. So you build a wall, if you like, around your free trade area. Common market, another step forward. So you've built your free trade area, you've put a wall around it, and you allow free movement of labor and capital between your members. Then we can go on another step and form an economic union. We form an economic union. We also have common institutions and economic policy. We've all seen how well that went. Monetary union, you also have a common currency, and obviously the Eurozone attempted that with varying levels of success. So big list of definitions in there, not too thrilling. But sometime before the exam, get them into your head. So why do we bother? The objectives of capital restrictions. Here we go. We mentioned this earlier, reduce volatility. Could be to maintain an exchange rate target. So you'll see central banks, and certainly in the reading on monetary policy, we said potentially trying to target exchange rates. If they do that using monetary policy, then they're really restricted from using that to do anything domestically. So you might try and maintain your exchange rate by saying nobody can buy and sell my currency, and that leaves you free to still play around with your own monetary policy. Could be to keep interest rates low or to protect strategic industries. So fairly straightforward list again, get them into your head. Balance of payments. A huge point in here about the balance of payments and how we calculate it, but it's going to be based on a relationship that you've seen twice before. So it's not a big area of the syllabus anymore. It used to be a lot bigger than it is right now, but you still need to know these basics. It's made up of the current, capital, and financial account. It is essentially just a dual effect accounting system. So if you have already, or when you look at the financial reporting material, get familiar with the dual entry effect. The idea is this balance of payment account should eventually balance back to zero. So your current capital financial should offset. Exam questions, every chance you get given a transaction and asked whether it belongs in the current, the capital, or the financial. And the rules are as follows. Current account, merchandise and services purchases, so the flow of goods, flow of services, foreign dividends and interest, unilateral transfers. So, to get a kind of woolly, not perfect, but maybe helpful analogy, think of the income statement in financial reporting, anything flowing through. Capital account, bit more balance sheety. So that's the sale and purchase of physical assets, resources, intangible assets, writing off debt, and any death duties and taxes. So kind of split the current and the capital to a little bit of kind of income statement versus balance sheet. Finally, your financial account, domestic-owned financial assets abroad, foreign-owned domestic financial assets. So that would be your debt that you own from an overseas country or somebody else owning yours. That's the idea. Now, once you've got that set up, to be honest, there's not too much else to do in describing it. My advice, do economics questions little and often, and you'll keep picking up questions that ask you, is this flow current, capital, or financial? And if you keep seeing as many of those as you possibly can, you'll be prepped for the exam. What's more interesting is how it moves. So this is the huge point I mentioned moments earlier. You've seen this relationship before. We're now expressing it as x minus m is s minus I plus t minus g. But that is the fundamental relationship from expenditure equals income. C plus s plus t equals c plus I plus g plus x minus m. We're just rearranging. We've now expressed it like this because we are isolating x minus m. X minus m, exports, imports, flow of goods and services. That's your balance of trade. So we can see the factors that influence our balance of trade. Let's just track through this first sentence. It says an increase in private savings. Well, our balance of trade is on the left-hand side. So if savings go up, holding all else equal, X minus M goes up, exports minus imports, if that's going up, that's improving our balance of trade. So an increase in savings improves the balance of trade. Or government savings, an increase in government savings if this term is going up, T minus G. That's taxes minus government spending. So yeah, that's government savings if it's written as T minus G, and that's going up. That improves or increases government savings. And the opposites are also true. The examiner can ask you for the impact on that balance of trade from any of those right-hand side terms. And the most common problem with this question is people just don't know how to attack it. I didn't know what they were asking me. Whenever you get a balance of payments influence question, a balance of trade moving, if they mention tax or government spending or saving or investment, go back to your fundamental relationship. Now, final point to mention on this slide, trade deficit due to a decrease in private or government savings. So we have a trade deficit, so this is turning negative. Why is that? Well, could be due to a decrease in private or government savings. Well, that's bad news for the government because they're heading towards a budget deficit. Bad news for savings. Well, people aren't saving. There's less investment. That's less desirable than a trade deficit due to high domestic investment. Look at this. That's minus I. So the larger your domestic investment, as this rises, just clear it out. If this rises, this falls. So you could end up with a balance of trade worsening due to high domestic investment. That's seen as less of a problem. We prefer that than government savings decreasing or private savings decreasing. Finally, a list of international organizations. I can't really add too much value to this at all, other than to say you have the IMF and all of their objectives. You have the World Bank and their objectives. And then over the page, the World Trade Organization and theirs. Obviously, I've added zero value to those two slides, but I don't want to just read out a list. You need to learn those lists of lists in the last 7 weeks, as I say. The most interesting material and certainly the most analytical in this segment is that early material on trade restrictions and their impact on consumers, suppliers, governments, and foreign exporters.